Hello and welcome to another edition of Nucleus Investment Insights. Today I wanted to have a run through what to do for self-managed super funds. Bit of some of the most common mistakes that investors make, and sometimes that can apply to other investors as well. But I guess what I'm really focusing on some of the asset allocation issues that you have, and I guess these can apply to your own. Your own circumstances as well. But we've got some stats that come out of the ATO, the tax office and ASIC, which sort of really track what people are doing within their self-managed super funds, and really does show up where we have some issues. So just remind everything you hear today is general advice. There's no personal advice involved. If you do want personal advice, then jump on our website and you can book a meeting. So I wanted to run through is a couple of different things. First of all, the reporting side of it. What can you expect around that, and what should you be looking? Because there are some common mistakes that get made there. What should you be looking for in performance? How do you actually try and get the fees? Because there is a lot of weird stuff that goes on with fees in terms of things that are sort of hidden away. And so I just want to sort of give you some of the key tricks and things to watch for when you're looking at fees. And then finally we'll get to those key mistakes that people make in terms of their asset allocation. So without any further ado, we'll jump into some of the reporting issues. And this is probably one of the most common areas of confusion for SMSF trustees, because what you get back from your accountant is really focused on what's been going on in terms of cash flows. So what's the money coming in, what's the money going out? If you've got multiple people, beneficiaries within it, it's really about making sure that that if I put an extra $5,000 in, that it definitely gets applied to me and not to other people in the fund, and who gets the increases from different parts. So which is all very important in terms of making sure that your the accounting's been done right. But that's not the investment side. That's about that's about making sure equality and making sure that you're meeting what you've said you're going to do. It's not about some of those key stats you really should be looking for in terms of getting to the bottom of what you're doing. And so, some of the things which I'd sort of try and get people to focus on is, look, first of all, that bottom line, what are the withdrawals and pension payments, and subtracting contributions, and trying to get back to a figure that is actually a return you can sort of hang your hat on. Because the issue with most super funds is, particularly in accumulation phase, is there's lots of money going in to them every year. Plus, you've got dividends coming through, and so trying to work out what your returns are can be difficult. And there's two parts to sort of these returns when you're looking at them. There is what you've called a money-weighted return, which is about how much you're actually making, sort of based on the amount of money. And to give you like an extreme example of that, so let's say there's an asset, and I go and put $1 into this asset, and it goes great. It triples in value. So I put $1 in, and now I've got $3 because it's tripled in value. So it's obviously had this great return. Now I go, hey, how great is this? I'm going to go give it another $97. So this has just been a small part, and now I'm going to throw a whole bunch of money into it, and now that asset, so let's say that was the first year of its, or first 6 months, say, and then the next 6 months I've thrown this extra money in, and now it falls by 3%. And so from a return basis that the investment manager is looking at, they're sort of basically going, well, we tripled our money in the first 6 months, and then we lost 3%, and so that's fantastic. That's a great year. You're up, whatever it is, 295% or whatever the case, whatever your number is in terms of it's been a great year for that asset manager. But for you, the investor, on a money weighted return, you put $1 in, you turn it into $3, so you've made $2. Now you've thrown an extra $97 at it, so you've got 100 in there, and you've lost 3%. So you've made 2 and then you lost 3. You're actually down on that investment over that time frame. And so making sure that you're actually adjusting or looking at your figures on the right basis is important. So yeah, so one way to look at it is that investment-based one. It's sort of the time-based returns, and so which is about saying, okay, well, how has that investment manager done at the investment? And the second part is that money-weighted returns, which is, well, that's my actual return, but is that because I've chosen the bad timing or other issues of over allocated to that asset, whatever the case is. And so you can try and separate those two decisions out. So that's quite important in terms of when you're looking at these performance. You want to be looking at your asset category breakdowns. And that's really important, and it can be difficult, especially if you're especially when you're buying sort of more esoteric assets that some of the bigger platforms or some of the reporting systems may not have a full look through into it. And so what do I mean by that is you might pick up say there's a what do you call it, a cybersecurity fund, cybersecurity exchange traded fund, and it might just be a relatively small exchange traded fund, and it might be listed in Australia, and you've bought it, and platforms which don't have a full listing of every single exchange traded fund, especially the smaller ones, might just look at that and go, well, that's an Australian equity. You've bought it on the ASX, and it's an ETF listed there, and so I'll just call it. And I don't know what it is, so I'll call it Australian equities. But that might be just full of, say, US stocks, and so knowing what's in it and trying to allocate it properly. There's a lot of systems that won't do it correctly, and sometimes you might just need to jump in and just change things around yourself. Sort of copy and paste these down into a spreadsheet and look, because you really do need to know where are you exposed is the most important thing. Knowing are you doing what you think you're doing, and what assets do you sort of have within that. So I guess we'll obviously pitch our own services, but one of the key things we do focus on is this idea of transparency. That some managers will basically say, well, we'll tell you what our asset allocation is, but it might be delayed, or it might be you might only get it once or twice a year or whatever it is. But the idea that it's a secret source that they've got, versus saying, well, actually no, we want our philosophy, and lots of others sort of have a similar philosophy to us, is we actually think of our portfolios as part of somebody's entire investment universe. It may not be the whole thing, and so we want to show what we hold, so that if they're holding other assets, they can actually sort of see what goes into that. Then you've got this the fees, costs, other expenditures, and I've broken them into sort of 4 different categories, and I'll go through in a little bit more detail in these in a minute. But because the way they get reported is different. So brokerage is the first one. Now, often you're going to need to try and extract that from your total cost and your total trades. So what do I mean by that is that if you spend, say you buy something and you spent $5,000 buying a share, is that the brokerage is often just added on to that. So let's say the brokerage costs you $20. That might be reported as $5,020 is the cost of the acquisition. And then when you go and sell it, let's say you sell it for exactly the same price, but this time you've got to pay the $20 of brokerage. So you bought it, you bought this thing, the actual value of the shares is $5,000, but that gets reported in your system as $5,020. And then when you go and sell it, it gets reported as $4,980. And so you can see there that looks like you made a small loss on the shares, and you have made a small loss on the shares, but it's because they've bound the cost of the trades into the value of the assets. And so just making sure that you know on what basis different platforms or different systems are including those brokerage fees, and sometimes they might not be showing them at all. It might just be sort of you might actually need to dig a fair bit deeper till you can actually see those brokerage costs. And sometimes as well, they might be sort of hidden in sort of spreads, what we call, often say in unlisted assets, there might be a buy sell spread where it's saying, okay, well, if I'm buying into this, I might need to pay whatever, $1.95, and if I'm selling out, I can sell out at $1.90 or whatever it is. And so there's that spread in it, which is effectively a brokerage cost in the end, which is saying there's, it's just expressed as a price rather than as rather than as an explicit brokerage figure. But nevertheless, you are paying that price because it's, the cost to buy in is different to the cost to sell out. The 3 A's, your admin, audit, and accounting costs. So, and I would treat this from an admin perspective as saying, look, try and separate out, if you can, the admin cost of the platform. So most superannuation funds or most platforms, most superannuation funds will have an admin fee, and most platforms as well will have some sort of admin fee that's sort of explicit and different to the brokerage cost. And so, and why am I separating that out? Because that's sort of giving you an idea of what your running costs are for this self-managed super fund. Because sometimes, and I'll dig a little bit deeper into these just to give you some sort of rough ideas about what you should be paying. But it's this idea that, look, if you are rolling out of a personal super fund into a self-managed super fund, you want to make sure that these costs aren't sort of blowing out. And if you're sort of paying 1% or more in terms of your admin costs, or even 0.5% in terms of your admin costs, you need to start thinking about, well, how high do I really want to pay just to be in this this structure? And so so important to keep track of those. Advice fees, which will sort of fit in or out. So I guess what advice fees are fees which you may well be paying regardless of whether you're in a self-managed super or not in a self-managed super, but making sure that that the advice fees you're paying match to what you think you're actually getting from the advisor. So, and what do I mean by that is that for some people you might be better off, say, having an advisor where you pay them when you need to, and you just pay hourly rates or a fixed rate or something like that to actually have the advice done. And so you've just got an inheritance, or you're retiring, or whatever it is, and you've got a specific event where you're like, yes, I'll pay somebody an amount of money to sort of sort this out for me, but then afterwards I don't need to get I don't need that advice for the next 20 years, and I don't need to be paying that ongoing rate. Whereas other people do need a financial advisor on a regular basis because it's almost a bit an investment coach, or they want somebody there giving personal advice on that the extra hand holding, and are willing to pay for that. So that's the advice side. And I guess what I'm saying there is, as well, as there's plenty of players out there, plenty of people out there, your providers and ourselves included, who charge for investment management, and most superannuation funds are on this basis as well. They'll charge for the investment management. There'll be general advice that they'll have some sort of hotline or something like that where you can call up and get some sort of, we're not telling you this is exactly what you should do, but we're telling you what people in your situation, what the pros and cons are, and the things you need to be thinking about. And so for a lot of people, that's all they really need on that ongoing basis. And then the final one's this investment management side, and this is fees can definitely be hidden on this as well. So brokerage fees are almost certainly hidden, or a little bit difficult to find. And investment management fees are exactly the same, and particularly, say, if you're buying an exchange traded fund, when you buy an exchange traded fund, there are investment management fees in there. And if you're buying more esoteric ones, and particularly smaller ones, or very focused ones, say, as I said, like cybersecurity, or you've got a crypto one, or whatever it is that you want to buy in terms of that, sometimes those fees can be really significant, like they can be 1% or more. And so, but you won't see that, like they won't get reported on your report if you're investing with a stockbroker, or investing on a platform. They'll show you the platform fees. They might show you some explicit fees for what you're doing, but those actual ETF fees can be hidden within that. So what you often see is internal cost ratios or things like that, and so you do need to actually dig into what the investment management fees, and one of the it's very common for us when we are talking to new customers that we're bringing on, for people to talk about, they'll bring back their statement, say, from an existing super fund, or their statement from an existing platform, and they'll talk about their fees being maybe 0.3 or 0.4%, And then when you actually dig in and show them, it's quite often well over 1%. And all these other sort of underlying fees are all hidden away, and they can be significant. Okay, so that's on the reporting. Returns. Now, for returns, I spoke about the money-weighted returns and the or time-weighted returns, and that's sort of your idea about money-weighted is the most important, obviously, because you really do want to see what you're making, but time-weighted is how you're going to judge the managers you've given the money to. Accumulation indexes are really important, and so if you just look at the S&P 200 index for Australia, and you say, look, what was that? That was up, whatever, it was up 7% over a year. And you might look at your own portfolio and you go, oh, my portfolio did 10, that was up 7, I was up 10, great, I'm outperforming. That index doesn't include dividends. And so your portfolio, obviously will include dividends, and you'll see it there. You want to be able to then, usually they're called an accumulation index or something like that. And that will say, well, the ASX did 7%, but there was another, 4.5% of dividend yields. And so the total was 11.5% for the year. And then, and now your 10% goes from looking like, great, I've outperformed the ASX 200 to like, oh, yes, but I've underperformed the accumulation index, the one that actually includes the dividends. The other thing then is in terms of your returns is really focusing in on, and when you're looking at those, sometimes exchange traded funds can be quite good at using as a comparison. So there are ways of doing returns based on various indexes, say Morningstar indexes, but you can also just use say a Vanguard balanced fund or something like that, that's listed, and just you can use that as a comparison of saying that's something that's going to do a mixture of assets. So and actually give you this asset allocation idea about, well, if you're only invested in if you're invested in a mix of Aussie stocks, international stocks, bonds, cash, property, other bits and pieces, then maybe you shouldn't just be comparing yourself just to the ASX. You should actually be comparing yourself to a broader index. And so, and that's where you get back to this idea when you're looking at your returns about saying, well, what are my returns coming from asset allocation, or are they coming from stock selection? And so what I mean by that is, if I separate out my Australian shares and go, yes, I look at my Australian shares and actually they're up by 12%, and so I've beaten the index on that. But I just didn't have enough of them. Like I had lots of bonds, or I had lots of cash, or something like that. And so my overall return was actually, was only, might have been only 6 or 7%. But I actually did really well in the Australian stock part. And so, so trying to separate that out in terms of your returns and reporting, and so you can actually just make a judgment about, what have you got right and what have you got wrong within that. If you do have self-managed, if you do have property and, traditionally residential, but I guess also commercial property within this, it's best to try and actually get your costs and your full costs of all your, including depreciation and other bits and pieces, and then subtract that from your yield to try and give you a better feel about, what is your real ongoing costs, because property can have some really lumpy cash flows, and it can feel it can feel different to the reality. So, for example, you might be renting out a property to somebody, and getting whatever, a 4 or 5% yield on that property, and it feels good. But then, and that you see that money coming in, but then you're like, well, actually, after I pay for my stamp duty, after I pay for my real estate fees, and then I pay for quarterly strata fees or whatever it is, and then you sort of get a better feel for it. And then you look at the depreciation side and you go, well, I might not be depreciating this explicitly, but the cost of my, if a kitchen's going to cost me 20 grand once every 10 years, then I've got this $2,000 cost every year effectively that I need to be factoring into that. If I'm going to have to replace carpets, if I'm going to have to replace floorboards, or I'm going to have to get the place repainted, or whatever it is. Some of those ideas that, the cash might look great where it's piling up, and you're like, look, I'm getting all this great cash, But if it's only because you're not seeing those depreciation charges and you're not actually accounting for those, then that's giving you a false view about how well it's going. And property is the ultimate for that in terms of surprise costs that pop up. All of a sudden, you've got to replace something that you didn't realize, and the profits you thought you made are gone. And whereas that tends not to, or it's very unlikely to occur in most shares and bonds and other factors as well. Your cost is your cost, and you've got your dividends, and there's all the ongoing stuff is sort of built into it. In terms of some of those costs I spoke about a little bit earlier, so just wanted to highlight that if you're trying to do your numbers to work out whether you should have an SMSF or not have an SMSF, I think in terms of the accounting side, if you're going to go to the online side of it, $1,000, $1,200 is sort of like about as low as what you can get as an ongoing fee for those. Then you can sort of get some of these hybrid type ones and sort of the basic service, I guess, from an accountant, where you're probably $1,500 to $2,000, and then at the upper end, and actually I've seen people with 10 or 20 grand bills coming out of their accountants. So that's you want to, I guess, make sure that you feel you're getting the service that you think you're getting out of that. And I think we certainly see lots of cases of accountants who decide that they want to go back and they're not going to trust whatever platform or brokerage or something like that the money they'll up all the numbers, and they need to do everything by hand themselves and get somebody to type stuff in and come back with a bill of saying, oh well, we just charge you 10 grand because we needed to have somebody go back by hand and type in every transaction that had occurred. And so I guess that's a question of if you think that's something that's valuable to be done and it's well worth the extra 5 or 10 grand that they're going to charge, or is it worth just finding somebody else who is is happy to take audited accounts at face value, so that's sort of a rough guide of what you should be paying. In terms of brokerage costs, at some of the lowest levels, we'll 10 cents or less in terms of some of the trades that we will do for people within sort of aggregated managed. I've called that MDA, but it's sort of more in terms of people who are managing large amounts of clients and they're doing aggregated trades and not sort of charging flat fees and that sort of. So someone like ourselves, we'll charge. If somebody puts an extra $200 into an account, we might go and buy 50 stocks and the trading costs are 20 cents. If you go to on a platform like, say, an Interactive Brokers or one of the brokerage where we can aggregate all the trades and just share out the cost between people. If you go to something more like a separately managed account, you're probably paying $2 to $5 a trade, and so you just, in that case, you want to limit your trades to trading like a couple of grand maybe at that point. If you're trading, say, $100 of buying $100 of stock for somebody, and it's even if it is costing $5 in trade, well, that's 5% wiped out on day one. So managing that trade size and when you're doing those trades is important. If you go to sort of online brokers, you're paying sort of $10 to $30, and again, it just keep thinking back to that. Even if it's only a $10 trade that you're doing yourself within your self-managed super fund, is saying, well, would I buy $1,000 worth of stock at a $10 trade and pay 1%? Maybe not. You want to make sure that you're doing sizes that are reducing that cost to sort of more reasonable levels. And then if you're dealing through a broker, that cost can get much higher. And then finally, that sort of financial investment advice costs, somewhere between 0.2 and 0.8, I think is sort of the more typical range. There's lots of places that are more than willing to charge you sort of 2% plus. And as I said, that can be often hidden within it. So that's I guess a decision for people to make, but it's the investment side of it should generally be if you're getting a very specialized product and returns that are commensurate with that very specialized product, then maybe you can pay that sort of 1 or 2% for it. But for most listed products, you should be paying less than 1% clearly for the investment side of it, and you want to be trying to add in your financial advice, your investment advice part into that as well. So if that's a sort of one-off, it's one thing. But if it's an ongoing amount they're charging, you want to make sure that that's you're not so high that it's really eating into your longer term returns. So let's get us through to some of the mistakes. Actually, and before we jump into those, we'll just go to a quick sales message.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Yeah, so getting into the biggest mistakes that people make is, and the first one I'm going to start with is doing nothing, because this is a pretty common event for anyone sort of listening into the podcast. And I've got a chart up just sort of showing over time SMSFs, the proportion of that they've got sitting within cash. And so there's only a relatively short history, so we've only got 5 or 6 years of this. But for most of the late 2020s, it was well over 20%, and even now it's sort of somewhere between 15 and 20% that self-managed super funds have just sitting in cash at any one point in time. And so within most investors sort of have this idea most professional investors take on this idea of cash drag, about saying, well, look, if there's too much cash sitting in there, that's just harming my performance. So if I think I can do whatever 7 or 8% return, but I've got 15% of my money, so I think I can do an 8% return, but I've got 15% of my money sitting in cash and not actually sitting invested at any one point in time. Well, that 8% straight away is going to be 7%. And so, sitting on cash and not doing anything with it is a big mistake a lot of people make. And if you dig into sort of the self-managed super fund, they break down some of these in terms of the size of the self-managed super funds, and you can see that it is a very linear relationship between how much cash people have and what cash is a proportion and how much money they have invested. And if you sort of take that as a proxy for sophistication, or at least sort of potentially using professional investors, professional advice, is that if you've got 100 to 200 grand, the average fund out there with 100 to 200 grand has got 40% of it sitting in cash, and that's just, I guess, a wasted opportunity sort of sitting there. And very much, that's, you might be doing 2% extra, versus you might have picked all the right stocks and all the right things, and you're doing 2% better than if you had just left your money, say, in a personal super fund. But if you're making the mistake of just not investing the money as it comes in and letting it pile up too high, then you've just lost that entire advantage because you've got just the money sitting there and not doing anything. So absolutely, mistake number one. Work out what your asset allocation is, you want it to be, and if you want to have big bits of cash sitting there, do you need a self-managed super fund to do that? There are, one of the things I didn't put in some of those fees I was talking about is there are online providers that if you've only got a cash account and maybe one or two other things, they'll actually give you an even cheaper rate on your, you might, rather than being $1,200 a year, you might be able to get down to $500 or $600. But I didn't put that in because if that's what your plan is, then just leave your money in a personal super. Why pay all these extra accounting and audit fees if you're just going to leave your money in cash the whole time? So mistake one, don't do nothing. Mistake number two is only sticking with what you know. And so there's a couple of books out that talk about this whole idea about invest in what you know. And And I don't mind that as advice, but that is stock picking advice. That's not asset allocation advice. That's basically saying, if you, Peter Lynch, I think, was one of the key ones for it. He spoke about, his wife walked into a store and she knows how busy it was all the time, and it's got these great products and everyone loves it, and so therefore go out and buy it, and that's fine. Not fine. That might even be good. As long as you're sort of assessing some value and stuff like that, as well as within that, saying, am I buying this at the right price? That's great. But asset allocation, and particularly for a super fund, is about the diversification. It's about getting the getting the right mix of assets. That's where most of your return is going to come from in the long term. Putting everything all into one stock or whatever is actually going to be is going to be a problem for you in the longer term if you're sort of going to take massive bets on single stocks. So yes. So by all means, when you're picking stocks, do use what you know. But in terms of your overall asset allocation, it might be about saying, okay, well, look, I'm going to have this 80% of it invested in, high quality stocks and cash and bonds and all these other things. And I'm going to save 20% of it for taking big swings at themes that I really care about or are involved in and or might know. There's also an element of should you be overweighting, what you've got into particular assets. So if that's where you're working. So say you're a cybersecurity expert, and you are working for a firm and working for a firm that's involved in it. Your salary is involved in it. There's an element of saying, yes, I would like to use my knowledge about which are the good companies in this sector and the bad companies and things like that to have some investment, specific that I'm going to do within that. But you don't want to pile too much into that, because now you're just you're putting all your assets into this one part, and you might run into the problem that something happens and there's a big downturn within the whole sector, and next thing you know, you're either not getting the pay rises you were hoping for, or out of a job, or something's gone wrong within that, and you've got all your investments bound up in that same factor. And so we've got a lot of our clients, for example, who use our sort of screening factors. And we'll actually go, okay, I work in the banking sector. I've got lots of exposure already to it. I don't need any more. And you might be getting shares or something like that, as part of your employment package. I actually don't want any banks at all in my superannuation fund, because and maybe that means the superannuation fund might underperform or outperform or whatever it is, but it's a personal risk perspective about saying, how much risk do I have to this sector across my entire portfolio. And so yes, so getting back to what you know. The other one I just want to note as well is crypto is making starting to make an appearance in some of these. There's this is this same chart showing by the size, so you can see it's certainly making a dent at the smaller end. So it doesn't really at a anything over, say, 200,000, is crypto is less than 1% of any one of the portfolios. You might know crypto, and you might have very strong views about what it's doing and where it's going and things like that. It is again that coming back to that question of diversification. If you want to do you really want to have all your eggs into that one basket, and particularly retirement assets, which might not you might not be getting for a very long time. Do you how loaded up do you want to be within that? Mistake number 3 is not having enough time to run it properly. There's or at least recognizing what you do have and what you don't have, and then outsourcing that to people who can do it for you. So I'm guessing in the most case, people are probably not doing the accounting and audit, or not that you could do the audit yourself, but there's elements of the accounting and other factors that they're saying, well, look, I don't want to do that part. Let me just outsource that to somebody. And so there's a question about then what are the parts of the investment side you want to outsource. So are you going to run this as a full-time job yourself, and do all the stock selection and the asset allocation and everything else, or do you want to sort of say, look, no, I'm running a self-managed super fund or I'm running my own investment strategy because I'm interested in some specific parts of stock selection, or some broad overview about asset allocation, or whatever it is that's made you decide you'd like to have that extra control, but then saying, well, all these other parts, do I need to do those? So, for example, if you want to have a corporate bond exposure, do I need to become a bond expert and cover all these different bonds, or do I just find somebody who I trust, or a basket of exchange traded funds where I can get exposure to that? And so, the idea that people are looking at these in terms of what's the risk, what's the return, do they have time to look at the efficient frontiers and the right asset allocation, depending upon the risk profile. Do you have time to do that rebalancing? And so, I'm not letting assets get out of whack too much, so that I start with, say an even split between 4 assets, and then one of them grows way bigger than the others. What am I doing? Am I rebalancing that back? Am I just letting it run, or whatever it is? But, do I actually have time and the effort to actually keep doing that, and making sure that you've just dropped, your employer might only pay quarterly into your superannuation fund, and they might have just dropped 5 or 10 grand into there. Has that actually been invested in the and it's not just sitting there for 6 or 12 months and building up those cash balances we talked about, just because it's not something you're thinking about, or not something you're paying attention to. So wanting to have that rebalancing discipline, asset allocation, and then there's also you might have time to do it at certain times, but knowing what you're going to do when you don't. So, and what do I mean by that? You might be retired. You love looking at the stocks and a bit of asset allocation and whatever it is, and now you're about to have a 3-month holiday overseas to visit grandkids, or do some traveling, or whatever it is. And saying, well, what am I doing for that time? What's my what is my process to make sure that the things that all the stuff we've spoken about is still getting done, and that asset allocation and rebalances are still getting done and looked at while you're doing more important things. Mistake number 4 is bad timing. So there's lots of different studies about this. The average retail investor underperforms by about 2% per annum. Now, most of that is because they sell low and buy high. So when markets have been going up a lot, they buy in. When markets have been going down, they sell or stop buying. And sort of a natural tendency, and I guess at the time, it feels sort of right in terms of saying, look, markets are going down. I'm worried we might be going to recession. I'm worried about whatever it is you're worried about that's sort of making markets go down. So I'm not going to do any more investing, or I'm going to sell. And then when markets are going up, okay, now I'm actually going to, there's obviously more confidence, and people think things are going better, and so therefore we're going to buy. The problem with that is, effectively what you're saying is, I want to buy high and sell low. So when markets are down, I want to be out selling. And when markets are high, I want to be out buying. And a lot about, especially long-term investing, and what you want to see within your self-managed super fund, is about having that strategy and sticking to that strategy. And it might be valuation based, or it might be based on earnings or economic strength and things like that. If that's your strategy, fine. Have your strategy, but it needs to be something you've sort of written down and set a plan out for saying, here is my criteria for when I'm going to buy and when I'm going to sell. It's not a bottom of your gut. Actually, today feels like the day I really need to sell everything, and then actually the market bounced back 3%. Actually, maybe I better just jump back in and buy everything again. It's about saying, have that plan, stick to that plan, and get your investments from there. And acknowledge that one of the hardest things with investing is fighting your own instincts, and that the average person will underperform by, as I said, 2%, almost all due to bad timing, because those instincts are often driving you in exactly the wrong way. Lastly, is the mistake number 5 is being under-diversified. And I've got a bunch of different, I'll get to some of the ideas I want to sort of come back to in terms of this, but I just wanted to highlight, a typical sort of Australian portfolio that we see all the time. And, people feel as if they've got diversification, and they may well have been to a broker to sort of get these, where they've got some cash and term deposits. There's a residential home. You might have an investment property. Probably have a bunch of bank shares. You got some hybrids as well to get you some of this income, and a corporate bond ETF. Now, one that I'm thinking of in particular, a client came with effectively this portfolio, and in the end, they've got sort of 6 different flavors of the Aussie housing market. So your cash and term deposits are there, but they're from banks, and the issue is if the Aussie housing market turns, then your interest rate on those is all going to fall. You got your residential home and your investment property. Yep, absolutely. You leverage to the Australian residential market. That's where they go up or they go down. That's going to, if the Australian residential market goes down, they're going down. You got these bank shares, which are effectively, the lenders, the largest part of all their business is to the Australian residential market. So the Australian residential market goes down, your bank shares are in problems. Hybrids, the vast majority of hybrids are banking hybrids. And so, yes, I've got hybrids, but it's just a different flavor of the bank shares. And then corporate bond ETFs. Now, there are good corporate bond ETFs that are diversified and have lots of different allocation across to other markets. But there's also a couple of corporate bond ETFs listed on Australia, which are effectively, once again, filled with Australian banking debt. And so, as I said, you've sort of looked at this portfolio that feels like it might be diversified, but it's actually just 6 different flavors of the Australian housing market. And so, knowing what you're getting, making sure that you have actually got some reasonable diversification within your portfolio is really important. I'm going to get a quick message, and then we'll jump into a little bit more about diversification and what you can do to improve.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now, direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right, now, I've once again pulled from the SMSF stats. Now, this is one chart. I mean, I think it's probably wrong. I like to hope it's wrong. It's a chart showing what the amount of international stocks are and international mutual funds as reported by self-managed super funds. Now, I'm hoping that there's probably a bunch of ones that are misclassified, as I spoke about before, that maybe they've bought an exchange traded fund listed on the Australian market that is actually just international shares, or they've bought some asset allocation funds which do have exposure to overseas, because there's a zero missing at least from anyone who does the asset allocation on an ongoing basis. Looking at this would say, you're missing at least 1 0, and you probably double it after that. Even once you add the 0, you could probably add another. You could probably double the size, and you get to sort of more reasonable international exposure. 30 years ago, international was this really small part of Aussie portfolios, and the idea was that you didn't really need international; you can get it all here, and a lot of that was sort of driven by the fact that it was actually quite hard to buy international, and so the last thing a financial planner or a broker wants to do is, when you turn up, explain that what you really should do is have half your equity allocation offshore somewhere, but I can't do it for you, and so go somewhere else. And so what did they do? Well, they convinced everyone that no, you can do it all in Aussie shares. That hasn't been the case for a few decades now. That there's been pretty good exposure to international, and that exposure is only getting better. Most funds that are running a sort of broadly diversified strategy and trying to do like multi-asset and run sort of balanced portfolios or growth portfolios, it used to be, even 15 years ago, they might have had, a third international and 2/3 Aussie. It's almost always at least 50-50 and often more than that in terms of how much is in international. And I think, especially as an Australian investor, I've spoken many times on this, that the Australian market is very, very different to international markets. You get sort of 60% of the market just from banks and resources and a few other things. And most other markets overseas, you're talking about 10 or 15% for those sectors. So, I've spoken that if I was a financial advisor in the UK or the US, and somebody turned up and I said, I'm going to put 60% of your money into, or 65% of your money into banks and resources shares. If that went wrong, I'm losing my license and I'm getting sued. But that's just the Australian market. That's, you show up and you get an Australian equity fund, and that's what you're getting. And so, so a key thing is to try to get some international exposure where, even if you might hate travel and you're thinking, well, what do I need this international exposure for? Well, you might hate travel, but you probably want to buy a car at some point in the future, or at least used cars that other people have bought. You're going to be mobile phones, you're going to be buying movies and streaming services and all these things like that are all coming from overseas. And if the Aussie dollar moves, the Aussie dollar falls, then all those services get more expensive. And so if the idea is that you want to sort of match some of your ongoing expenses back to, you want to match your assets and what's generating you income with some of your ongoing expenses, then having a reasonably large international exposure is important. And so, so I would very much be looking at people at having at least the same in international as what you do in Australia. And there'll be times where, for us at the moment, we look at the Australian market and the economic environment and the pricing of it relative to overseas, and we've decided that the asset allocation for us is more like 2/3 international and 1/3 Aussie, based on valuations at the moment. And so, got to get some extra diversification. I've got a chart up just for anyone listening in to the podcast. It's not seeing the video. It's a chart just sort of showing the correlation between different funds, and it's a very, very raw measure, and it's just sort of showing that there are lots of funds, like a total stock market ETF, that is just very well correlated with other sort of small caps or REITs or things like that. And then as you get broader and broader into different asset classes, you start getting these different correlations. And ideally, you can have these negative correlations where you've got, which happens from time to time, but you've got some assets. If you've got, say, bonds and equities, and bonds are going to rise by 5% over a year, and equities are going to rise by 7 or 8% over that time frame, or maybe not a year, maybe we're talking 10 years, is that they're not going up and down. They're not going up and down at exactly the same time. So you're not seeing the value of your balance sort of shoot up and then come flying down, and then shoot up and come flying down. If you can get those two sort of offsetting each other, that when one's falling, the other one's rising, they're both still going up, but they're just sort of at a different frequency, then it just means your overall portfolio is much less volatile. But also, it does give you that chance as well to flick back and forth between the assets. So, I'm invested in stocks, and stocks have had a great run, and I think that they're going to have a bit of a pullback. Then I can buy a bit more bonds, and then as the stocks have a pullback, my bonds might then be rising because economic conditions are getting worse and interest rates are falling. And then I can flip back out. I can sell my bonds and get back into stocks. Where if I'm buying things that are going up and down at the same time, then I don't have that opportunity. They're both up. They're both expensive at the moment. They're both down. They're both cheap at the moment. And so, having that diversification sort of gives you those a couple of different measures of that. And so, I just wanted to pull up again how we sort of think about it, and in terms of sort of what we think of best practice and the ideas about how you want to sort of form these portfolios. And the idea is that the word nucleus is this idea that there's this sort of core assets that you should have within your portfolio. And for me, that's Aussie government bonds, cash term deposits, international large cap shares, and Australian large cap shares. And why have I chosen those? Well, these are all the things when the proverbial hits the fan, they still trade. Like they're still things that you can actually get in and get out of. If you go and buy, say, an unlisted property fund, you might get these great returns when things are fine, but you hit something like a financial crisis, and let's say you lose your job, or there's got problems with other assets, and you actually need to sell it. Well, that fund might be locked up, and you might not get your money back for a few years. And so you want to try and make sure that you can have some of those assets and they're fine, but you're getting you want to make sure that you're actually getting a premium for those, and that if something happens, you may not be able to actually access that money. And so I want to try and make sure that there's this core sort of sitting in the middle that's, and for some people that's 100% of their assets. For other people, it's 30% of their assets, 40% of their assets, whatever it is. There is some amount that needs to be there in these high quality assets, and lower risk, higher quality. And then around that, now you can do some more interesting things if you want some small cap stocks, commodities, whatever it is, direct property, hedge funds, crypto, whatever sort of floats your boat in terms of those those other assets that sit around it. But having that idea that within your portfolio, what's in there for the defense side, what's in there for the these high quality assets, and which ones you've taken the risks on. And that way, as you're looking at your portfolio and your asset allocation, you can say, well, yes, there's some stock that I love and I know about it, and I'm either work in the industry or I know whatever it is, and I'm going to take this big bet on it. But a big bet is 10% of my portfolio or 5% of my portfolio. It's not 80 or 90% of my portfolio. And so, so trying to keep that in mind, and then also thinking about your overall other things you're doing as well. Is that, where do I work? I might have a business, and so do I want to be buying? Particularly if you've got a business, you're already exposed to heavily exposed to one sector. Do I want more of that, or actually do I just need less, and I actually need to buy assets that are going to diversify away from that? So that's hopefully a 5 things that people can do, people can look at in terms of the most common mistakes. A couple of things you can get out of that, hopefully, to see what you can do in terms of your asset allocation. Thanks everyone for listening in. Just a reminder that we are on every Thursday, 12:30 Eastern Standard Time, and we'd love to get any questions or comments. So feel free to write in if you've got any thoughts or something you want answered, and we will see everyone next week.